Welcome to RONAS Academy. So subscribe and become part of the learning family. Businesses, when not guided by specific standard or principle, will present item or will treat an item differently from one entity to the other. That means the way entity A will treat it will be different from the way entity B will treat it. And this will lead to problems when it comes to comparison or comparing a financial statement of one entity to the other and comparing an accounting period financial statement with another accounting period. This is the reason why the International Accounting Standard Board has established policies and principles just to harmonize the treatment and presentation of financial statement of several entities, just to enhance relevance, reliability, and comparability among different industries and from one accounting period to the other. One accounting standard that gives or that establishes the guidance for entities when it comes to adoption or adaptation of a new accounting standard is IAS 8. So basically today we are going to look at IAS 8, which talks about accounting policies, changes in accounting estimates, and errors. Basically that's what this tutorial is going to be about. We are going to look at how an entity can adapt a new accounting policy, and then when there is a need to change an accounting policy, what are the requirements? And we also look at accounting estimates, and then we look at errors. IAS 8, accounting policies, changes in accounting estimates, and errors is established to enhance the comparability of financial statement of one entity and the other. Remember that the qualitative characteristics of accounting information, they are the faithful representative, relevance, comparability, timeliness, and the rest. And therefore, for us to establish that those accounting information meet such qualitative characteristics, then they must be guided by a certain principle. Now, when we say accounting policy, so basically we are going to look at accounting policies first. So when we say accounting policies, we are looking at the specific principles, the specific basis, the specific conventions, the specific requirements, and then practices that an entity used in preparing and presenting its financial statement. So don't forget that is all about accounting policy. We are looking at the specific principles, the basis, the conventions, the requirement, the practices entity used in preparing its financial statement, preparing and presenting its financial statement. That is about accounting policies. When an entity is having an item or a transaction that does not have any specific accounting standard. So basically, we are looking at where entities are being guided by the international accounting standard. But in case, for instance, there is a transaction in the business and then the entity is not having any specific accounting standard to treat that, or there is no guidelines enshrined or outlined by the International Accounting Standard Board to govern the treatment of that particular item, then it is required of that particular management body of that entity to draft or to find out or to get a policy in the preparation or in guiding the treatment of that particular transaction or item. Assuming that the entity has undertaken a transaction and we don't have any accounting standard to govern the treatment or how you will treat it in the books of the entity, then the management are supposed to use their judgment in treating that particular item. In using their own judgment, they are supposed to be guided by the IASB framework, the International Accounting Standard Board framework. So you cannot do that. You cannot just use your intuition that, oh, because this one doesn't have a standard, let me do it this way. You have to also follow what has been outlined in the IASB framework to guide you in coming out with a policy that will guide the treatment of that particular item. Very, very important. Another thing you are supposed to look out for as a management when there is no specific standard or policy governing a treatment of an item is looking for a similar standard. Assuming, let's look at IAS 16, we have property, plant, and equipment, and we have intangible assets also having its own standard. These are different items, but they are similar in nature. So if you are treating an item, you should look for a standard that is similar and look at what the provisional, guidance have been enshrined in that particular standard to guide the management decisions in getting a new policy for the treatment of that particular item. This is just to enhance relevance and then reliability and comparability of that particular accounting information being presented by management. Remember that the treatment or the use of accounting policies, the management or entities must be consistent with it. You can't just say that you are using maybe the revaluation method for an item of PPE in 2019 and then in 2018 the same item of PPE are going to use the cost model. Comparing your statement from one period to the other becomes difficult, and therefore, and also comparing your financial statement from one entity to the other will also become problematic. Therefore, the standard IAS 8 requires that an entity, when that entity adopts a specific policy for the treatment of a specific item, then the entity must be consistent with the treatment of that particular item using that particular policy. Right. So we are turning our attention to changes in accounting policy. Previously, we looked at how an entity will use its judgment in treating an item that does not have any specific accounting standard governing its treatment and presentation. If that's the case, the entity is supposed to use its judgment in treating that particular item by taking into consideration the guidelines outlined in the framework of the IAS, that is International Accounting Standard Board, and also looking for any similar, treatment in other standards. We are changing our attention to, changes in accounting policy. When we say changes in accounting policy, what is it? We previously know that accounting policies are basically the principles, the conventions, the requirements, practices that govern the treatment or the preparation and the presentation of financial statements. Remember, when we say financial statement, we are looking at all the statements prepared by an entity. If a particular entity uses previously a policy and then there is a new one that has been devised or has been established, then there is a need to change the previous one to the new one. What it simply means is that, assuming that there was a policy A in 2018 and then in 2020 this same policy has been changed to policy B, then we say that there is a change in accounting policy. Before an accounting policy can be changed, there must be some conditions that are supposed to be met, or you're supposed to look for one or two things before we will say that, we have changed an accounting policy from one to the other. One is when there is establishment of a new accounting standard. So when there is a new, maybe IFRS or IAS, when they have revised the previous IAS or the previous IFRS, then we say there is a new, accounting, policy. The second one is that we can say there is a change in accounting policy if and only if the new policy will present information that is more relevant and more reliable than the previous one. Please don't forget, it's very, very important when it comes to changes in accounting policy. We are saying that we will say that an accounting policy has changed when this new policy is presenting an information that is more relevant and more useful than the first one. This means that if the new policy is presenting information that is having the same level of relevance, the same level of reliability as compared to the previous one, then there is nothing like change in policy. That is the second one. The first one is when the IASB has devised or established a new accounting policy. Right, there are some conditions that will inform you that there is a change in accounting policy. We have about 3 of the conditions or 3 criteria that will inform you that there is a change in the accounting policy. We have the first one to be recognition. We have the second one to be measurement. And then the third one to be presentation. All right. Anytime we say there is a change in an accounting policy, then we are looking at 3 things. Any of them happening, not all of them happening concurrently. They can happen individually. So assuming that there is a change in the recognition of an item, there is a change in the measurement of a particular item, there is a change in the presentations, basically looking at the classification of cost into administrative cost or maybe sales cost. That is about the presentation. There is a change in it, then we are saying that there is a change in accounting policy. Now we know when changes of accounting policy occur. How should we account for them when these changes arises? Anytime there is a change in accounting policy, it needs to be treated retrospectively. And a change in accounting policy needs to be treated retrospectively. What does it mean? We are saying that if you have realized that, assuming this is 2018, then this is a policy A, and then in 2020, this policy has changed. It has met all the conditions that show that this policy has actually changed. We have changed it to a new policy, which is policy what? B. If you want to treat this particular new policy, it is supposed to be treated retrospectively. But we only do the retrospective treatment when there is no transitional provisions in the new policy. This means that anytime there is a new accounting standard, it comes with transitional provisions. Simply means that there is a guidelines as to how an entity is supposed to adapt that particular new policy. But in case that there is an absence of transitional provisions, there is guidelines in the adoption of that particular new policy, then we are supposed to treat that particular new policy retrospectively. When we say retrospectively, it simply means that we are going to apply or we are going to treat that new policy as if it has always been treated, or it has always been applied, or it has always been been used. That is retrospective treatment. Practically, it means that if you want to treat this new policy, you will come back to 2018, and the way we use the policy A, we will change this old policy now to what? The new policy B. That is retrospective. You come back and treat it as if it has always been in use. That is about retrospective treatment. Please don't forget. Retrospective treatment simply means that you apply the new policy as if that policy was the one that we have always been using, although it is a new one. Let's look at this practical question on the screen. All right, so let's look at the question on the screen. The question says that previously, according to IAS 23 borrowing cost, they capitalize borrowing cost, or they capture borrowing cost as what? As an expense. They don't capitalize it as part of the cost of the item. So they prepare their financial statement, the balance sheet, and also prepare the profit or loss, therefore realizing the retained earnings for the 2 periods. So here we are looking at 2017 and then 2016. So in the previous year, in 2016, so 2016 will be the old year, and in 2017 this is happening. And we were told that the borrowing cost that they capitalized as an expense in these 2 years were 10 million. Dollars. So we are looking at dollars here. So million, and this place to dollars in million. So we are trying to look at how we will effect the change in policy, how you work it. So the question on the screen, that's what we are trying to solve. We were told that the borrowing cost that was capitalized or was captured, it wasn't capitalized because there was the old policy, but the new policy is saying that we are supposed to capitalize the borrowing cost as part of the cost of the item. But previously, what did they do? They expend it in the P&L account as an expense because that was how the policy was. But it has changed now that we have to capitalize borrowing cost as part of the cost of the item. It has to form part of the cost of the item. If that's the case, previously we have treated this 10 million as what? As an expense. But now the policy is saying that we should treat it as what? As part of the cost of the item. It should form part of the cost of the item. Then there is a change in what? Policy, because measurement has changed. And then presentation has also what? Has also changed. Therefore, there is a change in what? An accounting policy. So how do we solve that? Previously, we know. So let's start from the PPE. So we go back to our balance sheet. We do the effects, we do the changes, then we come to our what? Our retained earnings. So we were told that the 2017 PPE balance was $304. We are going to add 10 and add another 10. This is for 2017. And then we go to 2016. The carried down balance of the PPE was 251. And you are going to add 10 here. I'm explaining why we are adding this 10 twice. Remember that we were told that in each year, that means we are looking at these 2 years, there was a borrowing cost of $10 million that was captured. So a borrowing cost of 10 million was captured in these 2 periods. So if that's the case, in the first period, the 10 million will be captured as part of the cost of the item. And remember that we are going to transfer the carried amount to the next period, which is going to be 2017. So in 2017, the carried amount that was left here will come here. So that 10 million has to be included in the 2017. This wasn't done previously, but we are supposed to do it now. So if that's the case, the 10 million which was supposed to be captured in 2016, was the carried down balance was transferred to 2017. This balance here includes this 251, but we didn't add the 10 here. So now we are adding the 10 here, and then we come here and add the 10 again to the previous one. This 10 that was supposed to be part of this one, add it again, and then add the new borrowing cost that was captured or that was incurred in 2017. So that is why we are having these 10 here. So don't be confused. The reason is that in 2017 we didn't do it like that. We have captured this 10 million as an expense. That was the old policy. The new policy is saying that we should add it as cost of the item. Then if in 2016 this is our PP, then we should add a 10. So we are adding the 10 to this one. Remember that you will transfer the carried amount of 2016 to 2017. But we didn't do anything like that. We didn't add a 10. So now we are bringing this value here is now here without this 10. So we have to add a 10 million that was incurred in 2016, which is this 10. And then we add back the 10 million that was incurred in 2017. So in this case, we are going to have here 3 for the PP. Then we have other assets. So we have other assets. And then the value is probably the one we were given was 889. And then we also have 900 for 2016. It's not going to be affected here because the change in the policy did not affect the other assets. So our total assets is going to be 1203 here. 1203, and then we are going to have 1151 over here to be the total assets for the period. So this is about the balance sheet treatment. So they were saying that there was a share capital of 100, and this will not be affected also. So there was a share capital of 100 and it will also not be what? Affected. Now let's look at the retained earnings. We were told that the retained earnings in 2016 was 41 and that of 2017 was 42. How are we going to treat these retained earnings? So we are having retained earnings here. So let me bring it here, retained earnings. So with the retained earnings, that of 2016 previously, what they were doing was 41, and then that of 2017 was also 41, and then in 2017 they were having 42 over here. What this means is that, remember that they previously treat the IAS 23 borrowing cost as what? As an expense. So it has reduced our profit. Therefore, it has reduced the retained earnings what? Profit. So here, what are we going to do? We have to add back. We have to treat it as if this new policy, which is the new accounting standard, was in use from 2016 up to date. So if we were supposed to be treating, we wouldn't have less it from our profit. We would have added it to our what? Captured it over here, and it will not be captured in the P&L account. But in this case, previously, what they were doing was that it was treated as an expense, so that they have less it from our what? Our profit. They have treated it as an expense, therefore has less our what? Has lessened our profit, and we need to add it back as if that thing or that particular figure was not treated as what? As an expense. So in this case, we are going to have here to be 41 plus 10. 41 plus 10. We also have here to be 41 plus 10. And the same thing, 41 plus 10. So here is going to give us 51, 51, and then here is going to give us 52. 52. So this is going to be the treatment of the question. And we also have liabilities there to be 1,000. It will not be affected also because liability will not be affected. So please, anytime there is a change in policy, accounting policies, you have to look at the item that the change has affected. You go to your P&L account and see what has been done previously and what is supposed to be done now. Maybe previously they were supposed to add, but the new policy is saying that they should less. So you go back and treat it as if they have always been lessened. In this case, this statement looks as if we have always been applying the new IAS 23, as if we have always been capturing or capitalizing the borrowing cost as part of the cost of the item. Sometimes retrospective treatment is impractical. It means that we don't have the relevant information to go back and prepare our financial statement as if we are applying that new standard. We are applying that new standard already. If it is impractical to, treat your new policy retrospectively, then the standard allows that we treat it prospectively. From the current year that the new, policy has been introduced, we treat it from that time into the future. But remember, that is only when we don't have the relevant information to treat that particular item retrospectively. Okay, so now let's look at the accounting estimate. Remember, it was accounting policies, changes in accounting estimates, and errors. So three things that have been combined under one accounting standard. So let's look at the accounting estimate. So we are looking at estimate. Estimate arises as a result of new development or new information, as a result of an adjustment in something that gives rise to what? To estimate. Then we say estimate occurs when an item in the financial statement cannot be measured with precision, and that particular item there is so many uncertainty about it. Then we are saying that it is estimate. We cannot measure that particular item with precision, and there is so much uncertainty about that particular item. Then we are saying that it is an estimate. Example includes bad debt. We have inventory obsolescences. We have the fair value of financial asset and financial liability. The fair values of them, they are all estimates. The typical one that we always meet is the useful life of a non-current asset. They are all estimates because management is supposed to use their subjective intuition in trying to come out with a figure and present that in the statement of financial position or the income statement. there is a wide difference between estimate and policy. Don't complicate yourself with policies and estimates. Remember that estimates are subjective in nature. It is the use of management intuition to come out with some figures and they present them on the face of what? The financial statement. But when it comes to policies, policies comes with specific, principles, specific conventions, the basis for which an entity will present a figure. So, for instance, when we take an item of PPE, and we want to look at the measurement. So here, always remember the criteria for which we use to establish that there is a change in an accounting policy. Remember that we use the recognition, measurement, and presentation. So if there is a change in the measurement of a PPE, then remember that it is a policy. But when there is a change, but it's not affecting the measurement, assuming that there is a PPE which has a useful life of 10 years, and we are changing it to 5 years, has measurement be affected? No. Recognition, has it be affected? Probably not. And presentation will still be the same. But in this case, it's just the useful life, which is what? An estimate, because of a new information, because of what? A new development that has led to that changes. Therefore, it is not a policy, but an estimate. Now that we know how to identify an estimate and also differentiate it from a policy, we are going to look at how to treat estimates. Accounting estimates are supposed to be treated prospectively. So whilst accounting policies are treated retrospectively, accounting estimates are treated prospectively. That means that anytime there is a new change or there is a new estimate, or there is a change in the estimate, it needs to be treated prospectively from the day that it has occurred. You continue to treat it like that from the current period into the future. If it were to be accounting policy, we would have gone back and treat that new policy as if it has always been applied or it has always been used. Now let's pick a typical example as projected on the screen. We were told that an item costs $100,000. We were told that an item costs $100,000 and has a useful life of 10 years. And then, so probably after 3 years, the accumulated depreciation is going to be 3 multiplied by 100,000 divided by 10. And this is going to give us 30,000. So the carried amount of the assets. After the 3 years is going to be what? The 100,000 less the 30,000, which is going to give us 70,000. Remember that the annual depreciation is going to be 10,000, which is the 100,000 divided by the useful life, which is what? 10. Is that okay? And then if you want to get the accumulated depreciation, is multiplying the 10,000 by 3 because we have used the assets for 3 years. Now in the 4th year, they are saying that our new remaining useful life is 3. Please, let's underline the word there. Sometimes they can just tell you that the new useful life of the asset is 7. So there are 2 things here. The new useful life of the asset is 7 years. Let's say it's 6 years. And then the one that we have on the screen is saying that the remaining useful life of the asset after 3 years is 3. So the remaining useful life of the asset after 3 years is 3 years. But there can also be that the useful life of the asset has now been revised to 6 years. If you are presented with this information, how do you use them? How do you calculate them? This means that previously the asset was having 10 years useful life, but now it is 6. But this one is telling us that it is now the remaining useful life of the asset is 3. So this one we don't have to do anything about it. But if it were to be this one, we would have gone for the new years. Now that's the one we have already exhausted. The 3 years that we have already used the assets, which is giving at least 30,000. Deduct it from it before you get the remaining useful life of 3 years. So please always look at the um, content of the question and what the question is telling you before you go ahead and solve the question. So in this case, in the fourth year of which that the changes is being made, our depreciation is going to be this accumulated depreciation over here. Our annual depreciation, remember this one is going to be annual depreciation. Is going to be the remaining amount, which is the current amount, divided by the remaining useful life of 3. And this is going to give us 23,333 dollars. That is going to be our depreciation value in the fourth year of the asset. The reason why you are using 3 is that because the question is saying that the remaining useful life of the asset is now 3 because of the happenings, the uncertainties that's occurred in the fourth year. The same question can be stated that the useful life of the asset is now revised to 6 years, which means that we have already exhausted 3. So we take the 3 from it and get the remaining of what? The 3. And this will give you the same figure of 23,333. Please remember that this value didn't go and change the previously annual depreciation of 10,000. We are just treating it from the day that the information was available to us, from the day that the new development was made available to us. That differentiates accounting estimate from accounting policy. Let's look at the final part of the standard IAS 8, and that is errors. So sometimes the business may unconsciously or consciously incur errors. So we have what we call pre-errors or trial period errors. Basically, the focus of the errors that the standard is talking about is the prior period errors, but not the pre-period errors. So we are looking at prior period errors. The difference between the prior period errors and then the pre-period errors is that maybe in 2020 as of now, the business is incurring some some errors which is not affecting the previous account or previous financial statement, and that becomes a pre-period. So we just correct it from from now into the future. By a situation where you have discovered that there is an error in your financial statement, assuming you have presented financial statement for 2018, you presented financial statement for 2019 and that of 2020. And then in 2021, you have discovered that there is an error in you valuing your inventories over here. There was an error in you valuing your inventories over here. Then remember that we are in 2021, but the error is occurring in 2018, and this becomes a prior period error. But in case the error was happening currently, it is a current period, and that the standard does not take into consideration. The only errors taken into consideration is the prior period error. Remember, the errors can occur as a result of mistakes, misstatement, or undercast and overcast by the accountant or the management when preparing the financial statement. Anytime there is a prior period errors, the treatment or the correction is supposed to be done retrospectively. Please don't forget. So if you have realized in 2020 that there was an error in your financial statement in 2018, you have to go back to 2018 and correct it from that 2018 up to the year for which you have discovered the error. So errors, prior period errors for that matter, are treated retrospectively. So the same way you treat your accounting policies, that's the same way you will treat your prior period errors. So for instance, assuming that in 2018 there was some kind of evaluation of our inventory, we are supposed to use the cost model, or we know that we value inventory at the lower of cost and net realizable value. So in that case, the cost was 500, and then the net realizable value was 400. But the business valued the inventory at 400. Sorry, at the 500 instead of the 400. So lower of cost and net realizable value. The entity valued the inventory at 400. So this will affect all the balances from 2018 up to the current period. So what you have to do is that you have to go back, although we are in 2021, you have to go back to the 2018 account and correct that error over there. Go and treat that inventory as 400 and prepare the new account for 2018. Come to 2019, the balances that you get in 2018, you present it to 2019, and the same thing up to the current period. That is about what? The treatment of the prior period errors. Remember that every accounting standard requires some level of what? Disclosure. So all that we have done in the standard, the treatment, the method that we have adapted in accounting for that particular item are supposed to be disclosed to end users, for end users to use it in their decision-making process. So disclosure of relevant information in the standard are very, very pertinent. So this is about IAS 8, accounting policies, changes in accounting estimates, and then errors. Remember that accounting policies is the different item from estimate, because the policies arise as a result of change in recognition, change in measurement, and then change in what? Presentation. But estimates arises as a result of new information, as a result of new development, as a result of adjustment in a new subjective intuition by a management. And remember that errors may occur as a result of management being mistakenly, consciously making a fraud action, or unconsciously making mistakes in the presenting of the financial statement of an entity. Remember that we have error that will occur currently, but if it is a prior period errors, for that matter, it happened previously, then you have to go back and correct that error as if it has never happened. That is about IAS 8. Thank you.